Welcome back. This is the capital growth calculator that I've created, and I use it. I use it when I'm doing my due diligence. I use it at the end of the project to figure out whether or not this project should be kept. And towards the end, there's a section where I discuss your strategy, what your strategy should be, and at that time we refer back to the same calculator, because what you got to do is punch in numbers here to be able to figure out whether or not you're actually gonna keep, whether you're gonna develop or hold or develop or sell. So here it is. What I've done is I've actually put down the formulas that I've used here. All the blue cells you can actually punch in numbers, and all the yellow cells you can look at the formulas that I've used, you can play with it. You can do whatever you want with it, but just make sure that you save it as a copy when you do it, so that you don't accidentally override the actual main copy. So let's go on with it. Capital growth calculator. Basically, all I'm trying to do in this section here is figure out how long does it take for a property to actually double at the current capital growth rate. How long is that going to take, and how long and what's the actual capital growth rate that I've got, and if I haven't got the data, how do I get that data, basically. So say for example you purchased something at 239,000 10 years ago. Where did I get this data? Well, at this stage all I'm looking at is 3-bedroom houses in Frankston, and I'm looking at the 10-year data, and all I've done is I put my mouse over, and it tells me 239,000 based on 274 sales that happened in 2006. So I got that figure there, and all I did was 365,000 from 398 sales, the market value today. That's what I've done. Now if somebody tells me that the historical growth rate, historical capital growth rate in Frankston has been 5%, in 10 years time the property value today should be 389,000. Now don't worry about all these calculations, but that's what the calculation is in a nutshell. So that's what the property should be worth today. However, according to this data, the property in 2014 was 365,000. So the actual growth rate was 4.33, which tells me that it takes about 16.65 years for a property to double in value in Frankston, and not for a property, a 3-bedroom house. So that's one calculation that you can do to figure out how long it's going to take for it to double up, or what's the actual growth rate. So let's go down and look at the next one. Gross rental yield, GRY, and the formula for that is annual rent divided by purchase price times by 100. And I've actually continued with the same sort of example all throughout this sheet. So let's say gross annual rent is $400 a week, and the purchase price of a block of land in Frankston at the moment, I get it for $350,000. My gross annual rent is $20,800. The GRY is 5.94%. The bank interest rate, for example, after today's we had an interest rate cut today, so we are sitting at 2% right now. After today, I don't know, you might be able to get something at 4.3% or something. What that tells me that this property could be positively geared by 5,750 in a year. This can be cash flow positive towards the end of it. So that's what I'm trying to determine from gross rental yield. If I go on further, let's look at return on investment, which is annual profit divided by purchase price times 100. Now it's not a good measure. It assumes that the entire purchase price is paid in cash, unless property is sold. Unless the property is sold, capital growth is not included in the formula. So that's what that is. So annual rental income was the same, less property management, I don't know, let's say 5% at this stage. Then you've got less interest that you will pay on 4.3%, which will be that. Less outgoings, rates, insurance, so on. So what happens is the 5,000 that looked positive is actually down to 2,700, which is sort of positive, but not a lot. But at least it's not negative. I'm actually not a big fan of negative gearing. So yeah. So if you go on to return on capital, ROC, it's got a complicated formula here, which means that every dollar invested will return 1.10 as cash profit. So you've got land property acquisition cost $350,000. Then you've got the $70,000 cash injection, which was your equity contribution. Then you had stamp duty, legals, miscellaneous. So the total acquisition cost for $370,000 something. Then you've got annual rental income, less property management, less interest, less outgoings, and it turns out to be that it's going to be $2,710 positive. All this is the same so far, but let's say return on capital, that's 3.87%, and it's actually based on the $70,000 injection that you made, and what we are looking at here is that you put in $70,000 and you made $2,710. So that was 3.87% return. If you look at the opportunity cost, if you put the money in the bank, you make 3% without taking all this risk. So you got to make sure whether 0.87% return versus opportunity cost is worth the risk or not. And then you've got capital growth, which was that, and the total return, which was capital growth plus the rental yield, which was 5.2%. So you actually have to look at the complete picture rather than just, okay, that's the rent, that's what I get. So that's looking at the complete picture. The next one that I've got is growth on equity return. So you've got a purchase price for $350,000. You've got capital growth, which is 4.33%, and I've got that from here because we had put in these two numbers and we got that. So that gave me a capital growth of 15,000. So equity is equal to current market value less debt on property. So whatever the debt was, we deduct that, and we've got the growth on equity return at 12.59%. which is quite low if you're a developer, and and I'll show you how these things happen. Net profit percentage, annual income plus annual capital growth / cash injection times 100. So the net cash flow 2710 has actually come from here, which was your profit after you paid everything. Expected annual capital growth was that. So your total profit was 17,000, and your total cash injection was 70,000, but now it actually gives you a net profit of 25.5%. Now this is what you got to look at and say, okay, I'm outlaying only $70,000, and my total, including your capital growth that you will enjoy and the net cash flow, you've made 25.5% on your money on for that year. So this is the whole calculation for capital growth. As far as capital growth is concerned, one advantage that all the developers get is instead of paying the purchase price right here, they might be able, because they're actually getting the permits themselves, getting the getting a builder to actually build it, and they're actually paying cost. So that could be 290,000. For example, So that $60,000 that they were supposed to put in on their own was actually the profit that they would have made from day one. And if you put 290,000, you'll see how the return on everything just goes up. So now that actually makes sense, because then you also know that it is positive for the year. Don't get me wrong, the property over here is worth 350,000, but what I'm saying is, because you were the developer, you got the land, you got the permit, everything yourself, it actually ended up costing you only 290,000. So you generated the extra equity that you needed. So basically you're holding this property down for no money, and you can pull the initial capital investment that you made.